session, last of the 4 sessions, we'll cover percentage completion, financial reporting. We'll talk about budgeting, and then a little bit about the business model. In addition, we'll cover some of the concepts we've talked in the past about. So in our 4th session, we want to be able to read understanding the summary of contracts located in the help screens. We're just going to kind of pull that up. Go help in contents, then white papers and knowledge base. There's actually understanding over under billings is one of the concepts. Let me see if we can refer to the understanding the summary contracts. Just a second. Okay, so understanding the summary contracts, if we search for that, we'll find a document, and the document will cover a lot of the concepts. In your summary of contracts, it's not just a cost-to-cost analysis that you have to get a hold of, but additional concepts are in this document. For example, cost adjustments to back charges. There's a lot of documentation out of SOP 81-1, which is considered the GAAP guide for construction accounting. So how do you handle change orders, and what are the criteria for including unapproved change orders into your contract amount? Okay, talks about claims and how you deal with those. Revenues from claims should be recognized only to the extent of the contract costs related to the claim. That's only if it's probable that those costs will be recovered. So recognizing anticipated losses on contracts, that's a concept the software has in it, and basically if you have a loss on the contract, then you're going to recognize that loss immediately. You don't do a percentage on it. So there's the concept of a work in process schedule is where we're just dealing with the summary of uncompleted contracts. If we come over here to the summary of contracts and we print it, the difference between a work in process schedule, sometimes called a bonding report, or just a summary of uncompleted jobs, is that you're just getting the summary, the uncompleted job section. Okay, so when you get the completed job section and the uncompleted job section, then you're able to tie into your income statement. Okay, tying into the income statement is crucial if you want to prove your costs and really present, a much broader picture, a bigger picture of what's going on. So by doing an uncompleted job schedule and not tying into your income statement, you're just presenting really just a limited picture of what's going on. I mean, your over under billings might be perfect and everything might be fine, but what the bonding companies want and what users of construction financial statements, they want to see the cost tie in here, and they want to see the revenue tie in here. And this will tie in if we accrue our over under billings. Okay, so the problem with the work in process schedule, which is just an uncompleted job schedule, is that it doesn't tie to your accounting system. So if it's off, then you wouldn't know it. Okay, it's a limited presentation. There are different methods of accounting, basically, that you can interface with. For example, most of the contractors today that are closely held are probably a cash basis taxpayer. There are a lot of completed contract basis taxpayers, which means they recognize the costs and revenues on a project when it closes or it's close to completed, that kind of thing. Cash basis would be receivables in and out. There's something that we call the straight accrual method when I practiced in public accounting, and that would mean we're going to back off the over under billings and just do it on the straight accrual method. And then there's also a method that we called accrual less retention. So you'd reduce your revenue by your accounts receivable retention, reduce your cost by your accounts payable retention, and that would be the and then not have over/under billings on your tax return. So those are all taxing methods. Sometimes you'll see companies that recognize their contracts on a completed contract method for their financial reporting. And so from a construction standpoint or a project-oriented entity standpoint, those two methods are talked about a lot, the completed contract method and the percentage completion method. So the percentage completion method means you're going to recognize revenue as you move through the project. Completed contract method means you're going to recognize the revenue when the job's completed. If you're a home builder, this is the method we've typically seen from them, even on houses that they're not houses they've sold and basically are doing projects for an owner or someone who has a construction loan, that kind of thing. But really, they're the same. They should be on from a GAAP standpoint. If they are not doing a spec home or they don't own the project, they should be on a percentage completion method. And in GAAP accounting, sometimes you'll hear accountants say it's generally accepted accounting principles to be on a completed contract method. But there's a twist there. If you read the literature, SOP 81-1, it says it's okay to be on a completed contract method as long as it's not materially different, doesn't materially misstate your financial statements when compared to the percentage completion method. So essentially what it's saying is you should be on a percentage completion method. So now, just from a theory standpoint, you can do anything with your financial statements as long as they're not materially misstated. So that's basically a given that you could use the cash method if it's not going to materially misstate your financial statements versus what's considered generally accepted accounting principles. So anyway, so some of the concepts in this area that you can read on your own, and then in the help screens especially the manual that you can download off the internet. And let's cover that real quick. So if we go help and release notes, let's see if we can find it here. We go down to help links. Maybe it's not there. Oh, there it is. The 2012 user guide is on the internet right now. And we didn't quite get that, so I'll have to figure that out. So we'll get that link fixed. I think it's on our webpage too. You can pull up that user guide off our webpage. So in that user guide, there's summary contracts and it shows you how everything ties back and forth together, including how it ties to the previous year's summary contracts. So if you look in the help screens, you'll see a sample summary of contracts and a sample balance sheet sample. And so if we look that up right in the help screens, I mean, we're not going to cover these concepts, but in this, if you print this out, you've got the current year summary contracts, the prior year summary contracts, and then you have numbers and letters that reference back and forth, and so you can kind of see how what's supposed to tie. Like, this is hard to read, but your cost plus gross profit. The prior year number would be the uncompleted jobs cost plus gross profit from the previous year. And if you go to this balance sheet, one has both the balance sheet and the income statement, and the same numbering schemes tie in. Like, for example, if you see the one would be, this is hard to read. Let's go over here. Revenue is going to be 3. And revenue is going to be 3 right here. So if you don't know, to study this would get you there if you don't fully understand the summary contracts. And with the letters and numbers and how everything ties back and forth, I'd encourage you to print it out if you don't have a complete understanding of it. So over under any organization like some organizations are very focused on their over under billings. We had a company that was considering just going to us for the summary contracts, and I thought that was kind of crazy, but we do a great job with the summary contracts, and they were a good-sized company. But so the over under billings is something that I would say most organizations will focus on once they get to a certain size, and some small organizations are very focused on it, and it really just ties everything together, and it gives you that monthly report card kind of a thing. Like, you want to do things as accurate as you possibly can. GAAP accounting is really geared for, general accepted accounting is really geared for fairness. So what it's trying to accomplish here is something fair. So if you know where your financial statements, your bottom line is every month, you're getting a fair number out of your bottom line every month, then you have a leg up in business because you have that instant feedback, or that quick feedback on how well you're doing. And if you're always paying attention and you're always trying to figure it out, then that's a good component to have in that mix. So those are some of the concepts. So initially when we started the webinars, we said, that's your homework to kind of review those items, but gotten away from that a little bit. The documentation's there. I think most, at least some of you guys, fully understand that area. If you don't fully understand it, I would encourage you to get to that point. So what are we trying to accomplish? We're trying to present one possible solution for controlling costs through the utilization of a process. Okay, and then I would say that we're probably trying to accomplish, and okay, so, and we're trying to present the big picture with respect to how cost control supports your estimating process and your overall, your organization's overall financial picture. So everything ties together in that, you start with an estimate, you have cost control throughout your projects, your financial statements are generated monthly. At the end of your project, you have budget actual variances on concepts such as, how'd you do on your labor, and your labor is broken down between the production variance as well as the rate variance you used in your estimating process. Cost control components for subcontracts and purchase orders gives you that control throughout the project, so that if you overspend on a line item, you're searching for why you overspent, so you can eliminate the issues in the future, whether job materials are disappearing from your job site, or your estimating process is deficient, or that kind of thing. The three cost control mechanisms we talk about would be subcontracts, purchase orders, and job status hours. Okay. Job status hours, with respect to that concept, what budget report shows budget actual variance on all types, and gives you the budget actual variance versus for labor, along with average budget actual hourly labor rate variances. So, and that's going to be two reports we've talked about. So we'll hit both. The budget report that gives you this information, including additional information on the right, versus with your labor hours, is the report that shows up under your revised budget column. Whoops. Okay. And I drilled down a little bit further than I wanted to when I pulled that up. The other report that we talk about in this webinar that supports that whole process is this labor performance, and I've shown you this before. And so this one gives you the variance due to your hours or your production, and then your variance due to your rate. Okay. Okay. So it's the revised budget column was the answer on this one. Okay. Job status hours. What report do we distribute to the field to get revised estimates on hours to complete and percent hours complete? So on a project that's going to go, beyond a short duration, over this projected column gives you that job status hours so that you can get the accountability from whoever's in charge of the job, so they're telling you how they're coming in. So if there's going to be a difference, you're getting that feedback early. And they're also projecting that there's not going to be a difference, and they're paying attention to what's going on. So where do we update the hour percentage complete obtained from the field via the job status hours report? So we fill this report out, and then we update it in the job status grid. And the job status grid is under the status and status here. On the job status grid, we want a subtotal by type when we're keying in the hours percentage complete. And so that's why we're subtotaled by type. So we drag that up by type, putting that up. And then here's our labor here. We sort by the this column to get it in the order that will show up on the report. So by phase, cost code, labor, and then we come over here and we bolt in our percentages. So that's one alternative for you. Okay, so part of the reason we put these questions in this area, in this section, is so that you can look them up and you say, okay, what was that report? You read through your questions, go to your Concepts tab in your Google Doc, go through your questions in session 4, and it'll tell you the answer, okay? So you don't lose. So at least you have some sort of reference into the material that we've covered. What report allows us to review the committed cost by vendor sub? So it's the single job print billing commitment analysis. So we go over here to this single job print, highlight the job we want to report on, go to the billing commitment analysis, click print, and it's just going to print that one job. It's going to show you all the vendors and subs on the job with the commitments we've signed up for. Air Rentals, for example, does not have a commitment. However, there was accounts payable on the job, so it's going to show up in here. So these are all the vendors you've used and subcontractors. And if you click on this first column, this on-demand sub-report will show you the commitment. It'll show you the AP invoices that will come in. If there are any checks, it'll show you the checks, and it shows you the variance or difference here. Another report that gives you committed cost that you have quick access to would be on this dashboard report, this commitment balance concept. It'll give it to you by vendor sub, POs, invoices, checks, AP, the balance on the commitments. Okay, so this is also by vendor sub. This is by vendor sub. And then the job status reports are by phase cost code. So the job status reports, you could look at this variance column, and it's got one of the job status reports. And you'll notice that the job status report is very similar to the job status grid. So this is basically the same information. The job status grid, you can modify to complete the total estimated cost of the percentage. Over here, you can modify, you can't modify anything because it's just a report. And this is actually at the phase cost code level in this report. It's not by type. If I want to see the types, I double click on it, then it gives me my types. Okay. There is no sub-reports underneath the sub-report. That's one of the limitations of the system. And Crystal reports specifically, so I can't just keep creating sub-reports within sub-reports. So you have your master report, and then you put all your sub-reports here, and then when you click on it, it'll pull up the sub-report. And from that's underneath that sub-report, you can't go another level deep. That's why you'll have to use some of your job status reports if you want those concepts. So if we come over here and pull up one of the job status reports, you'll see that there are on-demand sub-reports on this report. So here's a status report with on-demand sub-reports. Okay, so if we come down here to this change order, change order number 1, the 22,000, click on it, we get some of the same information we looked at before. Okay. So the on-demand sub-reports are nice in that you can quickly see where the number comes from. What's the support behind the number? So the job status reports, let's cover that real quick again. The job status reports are underneath job cost, and then job status reports, and there's a series of them, a bunch of them that you can select from in different formats with different columns turned on and off. If you want to edit one and change it, you would do it in here. And you can do a support call to get you started with that. If you take the Crystal Reports webinars, that would make a big difference too with modifying existing reports. What reports allow us to view the committed cost by phase cost code, and that's the job status reports. Okay. So you can also print the PO subcontract tab in the job notebook. And I believe that let me show you that. See if the valid reports are behind there. Yeah, so there's just one more, an additional report that you can pull up. And you don't have to, you can just use this screen as the same concept. Gives you totals, that kind of thing. And from here you can drill down on your commitments. What are the two options for generating committed cost transactions? In the bid item grid, you can create them, or you can create them under the PO subcontract transactions tab. So PO right there, or subcontract right there. Those two dialogues can be modified under Utilities Customize, Purchase Order Screen, and Subcontract Screen. So if I go to the Subcontract Screen, you'll see that the same fields that have check marks on the left will be on here. The check marks here for stopping, so you'll notice that if I cancel this and I try to, when I toggle across hold and job number, it will not stop there. So just to show you that. So now hold, it's going to jump over hold and phone number because that checkbox was not there. There was no checkbox there. If I check that, it would stop there. And so you have a long list of columns and features that you can turn on with each of these concepts. The distribution is here, including retention concepts. The basic tab is here, which is right here, and the items tab is here, which is right here. Same concepts with all the rest of the transaction dialogues. What are the reports that prove your job cost tie to your income statement? Your month-end financial statements that tie to your job cost, to your income statement and balance sheet. So the reports that prove your job cost tie to your financial statements would be your month-end financial statements, which includes your income statement, balance sheet, and your summary of contracts. So accounting side, balance sheet, income statement, job cost side equals summary of contracts. Okay, so what needs to tie from your job revenue and cost to your income statement? The total revenue on your income statement needs to tie to your total cost plus gross profit on your summary contracts, and the total direct costs, direct and indirect allocated on your income statement tied to the costs on your summary contracts. So just to cover that, so your direct plus your indirect allocated ties to your summary contracts right there. And after you post your over under billings, this cost plus gross profit column will tie in here. Okay, and that all that information is in these help screens with that, especially with this document here. Okay, manage your company. So managing your company through your financial statements. What's the concept? So you're getting monthly performance control measures on the projects and the financial condition of the company as a whole. So monitoring where you're at with that, and not spending money when you're not making money, or making decisions based on how your performance is, and setting goals and measuring against those goals would be managing your company through your financial statements. Not paying profit sharing if you're losing money, paying profit sharing if you want to pay profit sharing if you're making money, that kind of thing. What are you trying to accomplish by posting your over under billings? We're trying to match our revenues with our costs incurred through the cutoff date plus the profit on those costs. So if we look at our summary contracts, we've got costs, and then we're saying we're % complete, and we think we're going to make a certain amount of money. So this is the revenue, the markup on those costs, those two columns. So this is the cost plus the markup, or the cost plus profit, right? And we're just comparing that with what we've actually billed. What we've actually billed is what's sitting in our revenue account. Okay. When we do a billing, it hits this account. When we accrue our over under billings, it hits this account. And our over under billing is going to be the reversing from the previous year. We covered that last time. Your previous year end reversing entry of your over under billings plus this month end's over under billings. So the difference between this number and this number is not this number. It's a combination of, this number is a combination of that difference plus the difference at the end of the previous fiscal year end. Okay. Let's cover some concepts with bottom-up budgeting, that kind of thing. So if we come up to this Google Doc, we've got some different tabs. Let's just kind of cover the Google Doc, and what we have here, we had our agenda, then we have an income statement where we're comparing our bid with our income statement, and the concepts are similar. Okay, so we're trying to take our income statement and correlate it to the estimating process. So in a typical estimating process, we're dealing with markup, right? We'll take our cost, we'll mark it up a percentage, get to a bid amount. In the income statement, we're looking at a margin. It's really a percentage of revenue, so we always have to make sure that we're talking, when we talk about margin versus markup, we don't talk about apples and oranges, we're talking about the same thing. So the summary contracts can be print with both the markup or the margin, either one. And when that's done, this column will say cost, or it'll say revenue. So as a percentage of revenue is margin, percentage of cost is markup. Markup is what you see in the estimating process. Accounting process, you see margin as an industry standard. Okay, just to make it hard, right? Okay, so on our model here, we have a bid, we have direct costs. Simply, you're going to come up with your cost by, phase, cost code, whatever, however you break down your costs, and then you by type, labor, material, sub, equipment, and other. So this would be the total of all the cost codes. So we come up with, we think it's going to cost us $21,000 to do it. We do a 20% markup for profit and overhead, and we get a bid. Here, where the job's completed, we've done the job. Let's say we came in perfect on margin. On our budget, we're going to have our cost of revenue, our gross profit, and that's 16% of our total revenue, with operating expenses and income from operations. So profit and overhead is really those two added together. Profit and overhead is really gross profit. Gross profit is another way to say gross profit is it's our operating expenses plus our net income. Okay, so here profit and overhead, this would be profit, and this would be overhead. Concepts. So the webinar is organized by just a series, we just ask some questions and answer, and that's how we're moving through the material. So our session 2 questions and answers, our session 3 questions and answers, and our session 4 questions and answers. Here we had the next tab, we have cost type definitions, and we're talking about, what is a direct cost, what is an indirect cost, and what is a G&A or operating expense. Sales, G&A, operating expenses, that kind of thing. Home office, those are all kind of the same thing, and other income expenses. So you can see that you probably, in your income statement, you'll have revenue, and then you'll have direct costs, indirect costs, G&A, other income expenses. But here we're just trying to say, identify the differences between the different kinds of costs. So we went through this in that first session. The direct non-job GL accounts, here we're trying to define how the system's put together with respect to burdening for the most part, your labor. So in your labor, you'll have, for each time card row, like this represents a time card row in our example, you have gross wage, you have FICA, Medicare, Social Security, Medicare, Workman's Comp, General Liability, 401k, FUTA, SUTA, federal unemployment, state unemployment tax. So instead of having 1, 2, 3, 4, 5, 6, 7, 8 rows in job cost, we put 1 row in job cost, we total these up, and we put it in this labor burden column. So if you look at your general ledger, if you look at the tables, you'll have a transaction table that your job costs are driven from and or derived from your job cost reports. As those same tables, your balance sheet, income statement, general ledger, are also derived from the same tables your accounts payable aging, accounts receivable agings are derived from. And that's the difference between a relational system and a modular-based system. And we're a relational system because the same tables are used to generate your agings, to generate your job cost reports, to generate your general ledger, and that's a superior concept. And that's why we have as many features as companies much larger than us. In fact, we have more, in my opinion. But so you have an amount value, you have a labor burden that sums these items up, and then we also have a percent burden column. And the percent burden column basically is just as an additional column so that we can say that's the percent burden here. How much of these indirect costs have we captured? The labor burden columns are really for these columns that we know the percentages on, like if you just do work comp, general liability, 401k type of stuff. We know those percentages, so we treat them as direct costs, even though when they go in, they don't get a job number, but the total of these numbers will be in a separate column on this direct labor row. So then when we pull our job costs together, we ignore these, but we pull that separate column in called labor burden, and therefore we tie in perfectly so that when we look at this 111,929, 111,930, it ties in perfectly, and we don't end up with 8, 10, 12 rows of job cost for one labor row. So when we drill down into our job cost reports, we're looking at one row here that includes my 5363 rather than 8 rows and making the detail useless or too detailed, not useful. Okay, so then we're back over here to our business model, and whether you identify your business model as an organization and document it, or you just recognize that you have a business model, whether you document it or not, and that business model includes several components. It can include a failure criteria, and whether you identify it or not, I mean, probably if you lose money, that's failure, and maybe if you make an amount of money that you believe you should be making, then that's success. Okay. So if you identify your failure model, your overall financial statements can prove that failure model. Did I make money? Did I not make money? Did I make 10%? Did I not make 10%? You have cost control mechanisms in your organization, and maybe they include purchase orders and maybe they don't, and subcontract agreements. Maybe they include budget actual variance reporting that's shared with the field on labor hours, shared with the project managers on overall performance on the projects, or not shared. Okay, maybe you've got projecting on your cost control. You've got projecting reports like job status reports. Okay. So in your business model, do you tie your job billings and costs, your double entry system of accounting to your summary of contracts and present it monthly? That's a successful model in all companies. I would say probably. I'm not sure what the threshold is, but I can tell you all companies over a certain threshold are going to do this. So unlikely that they don't. But I've seen large companies that don't do this, and they're successful. So it doesn't mean you're going to be successful if you do these things. It just means you're going to get more feedback, or maybe better organized in doing things from a generally accepted accounting principle standpoint. Probably have a better chance. There's probably a better correlation between control and people who do this, and maybe different types of controls outside your accounting system they would have to have if they didn't do that. Okay, so bid the bottom line. So here's a concept. Do you understand what you're bidding for? You take your estimating process, and in your mind's eye you say, okay, we're probably going to bid so many estimates are going to go out the door, and we're going to probably win based on last year. If we win $7 million, then we're even with last year, and we're bidding at a percentage. So we're bidding on the same pace as last year. The market's similar. We did $7 million in business last year, and this year if we're going to do $7 million and we're bidding our gross margin at 20%, what's our bottom line going to be? You take that $7 million times your gross profit, subtract your overhead, and that gives you a bottom line. And that's where we come up with the bottom-up budgeting, and we're going to go over that in a minute. Bottom-up and top-down budgeting, that kind of thing. So efficiency audits, field estimating, and administratively. So how does information circulate through your business? Are you doing a bunch of things with Excel? How much money is that costing you to generate things with Excel? How efficient is your estimating? How efficient is your field? So the efficiency process in your overall ability to be competitive in the marketplace, along with the accuracy of the information that you're producing. That all kind of goes into those formulas. So I do efficiency audits for companies, and so if you're interested in, from an administrative standpoint, estimating cost, your cost control concepts, how you're using the reporting, what your system looks like, and I can talk to you about that. So vision for where you're heading, the bottom line you're bidding to, and that's kind of the same concept we talked about up here. So bottom-up budgeting, there's a tab here, and what you can do to, you should take, and if you use this, make a copy so it's yours, so you can manipulate these items. So you can bolt in your numbers from last year, that kind of thing. So the bolded items would be the numbers you would change, and you would say, okay, for example, so you bolt in last year's number here, and everything else is derived. Okay, so if you go to your bottom line last year, and you say, okay, my bottom line on my income statement was 400,000, right? And our gross profit percentage from my financial statements were, say, 15%. This is basically what your income statement is going to look like. This is going to calculate your revenues, your job cost, your gross profit. Everything's just going to be done for you automatically. It may be 1,000 or 2,000 or a certain limited percentage off, but it's going to be pretty close. Okay, so if I come over here, let's see, this is what we ended up with. My overhead was 536,290. Well, this actually is going to roll from over here. It just added it, but you can change this, my break-even point. If I put this number in this worksheet, my break-even point will be calculated, and it'll tell me what I have to do for next year to break even, given my same model, my percentage, gross profit percentage. Okay, and the gross profit is not whereas my 100% is at my job cost number, not my revenue. Gross margin is my 100% here. Gross profit is my 100% here. So if you see gross profit, you're going to do this. 100% is going to correlate there. If we go down here to the gross margin concept, here's the same thing. So what did we say? We said 400,000 bottom line. So our margins here and our profits here, and then so I think these are basically the same model. Not sure why we did that. Maybe we didn't have both columns when we first did it. So then you can take this model here and you can say, okay, well, what if we win twice the business as we did last year? What if we win 15 million? What if we perform on 15 million? What's our bottom line going to be? So 15 and 100%. 13.0486, so that's right. We just didn't have that added. So then if we do 15 million, we'll expect $1.4 million in net income given the same margins. If we want to do 20 million, we're going to do 2 million. We'll do 2 million, and if we do 5 million, we're going to make 115,000. So it kind of gives you that business model. Over here in this cost type definition, we talked about fixed versus variable costs. Where our direct costs are variable, our indirect costs have both variable and fixed components, and our home operating expenses are fixed from a theoretical standpoint. And they are, unless you change your overhead, they're going to be fixed, right? Okay, so here we had, looks like this section is somewhat obsolete. No, actually, this is not obsolete. What we did here is instead of this is calculated versus this is not calculated. So here we're changing the gross profit percentages that the estimators are bidding. So if you say, okay, there's more work out there or there's less work out there, we're going to do 12%. What is that going to do to you? As far as this is the bottom up, I want to make 400,000 at 12%. I got to do $8 million in business. If I'm going to do 10%, I got to do $10 million in business. And if I'm at 15%, I got to do $7 million in business. Okay. And so this 15% is driving this break-even analysis. So, and this 15% is driving this. So here, 7 million. Drives the number down to what you're making. Bottom up, top down, and break even. What do I have to do to walk away with in the same position as I was at the beginning of the year? If I'm bidding at 15%, I've got to do $4 million in business. So here we're changing the margin versus gross profit. So some companies bid on margin, and this would be more appropriate for them. Not a lot of them, but some do. Pre-tax margin deals more with the before tax numbers.
Hey, Eric, when you say margin, because everybody goes back and forth, are you saying that's like the markup the estimator is putting on the job, or are you using gross profit as what the estimator is putting on the job? You know what I mean?
Mm-hmm. Yeah, gross profit would be that you come up with your costs, then you do a markup on those costs, right?
Right.
That would be gross profit.
Okay, I just wanted to make sure when I look at your spreadsheet, I know how you're defining that.
Yeah. So if you look at your gross profit percentage, is going to be 15% of your cost is going to equal this number.
Okay.
13% of your revenue.
That's the margin.
Is going to equal that. That's the margin. So the margin.
Okay. I'm just making sure I got your definition versus how it's kind of stated around here.
Okay, good. Okay, so these are good concepts, especially for, maybe budgeting for that year end. Where are you headed as an organization with respect to your estimating process? So, these are really simple concepts, and if you play around with them a little bit, it's not hard to grasp them, that kind of thing. So in my opinion, you keep things as simple as you can, but come up with a good overall picture of your organization and how everything comes together from your financial statements to your summary of contracts to supporting your estimating process by producing, the hourly rates that you put into your estimates, and supporting your estimating process by tracking your commitments through the project, making sure that you spend what you thought you were going to spend, and putting control measures in place so that, which is what a PO and a subcontract, and then the overall reporting to make sure that the reporting supports where you're at. Okay. Here's an example of over-under billings. I don't know that we really went through this, but it kind of gives you, this is the reversing entry process. Did we talk about this in one of the other webinars? I think we talked about it. I don't know if I used this spreadsheet to illustrate it, but you bill in one. Look, here we have a concept where January's our period end and February's the next month. So before we do any billing, we start a job, we incur $27,000 in costs on that job, and we have no billings. So we look at our gross profit. This is just our income statement here, right there. So we have gross profit, negative $27,000. New company, one job, that's all we have. But we did $27,000 in business, so did we really lose $27,000 in gross profit? And the answer is no, because we can actually bill for the costs plus the margin on those costs. Okay, so if we calculate the margin on those costs to be roughly $5,000, this is what we're doing here. So the margin should be $5,000. So we do an over-under billing, so we basically increase our revenue by $33,000. So then we look at our overall income statement after we do our over-under billings adjustment, and it shows that we made $5,000. So we post that adjustment, right? Then we do a reversing entry on the first day of the next month. And so we're going to reverse that revenue entry. So the first thing you look at in the next month is a $33,000 loss, right? But then you turn around and you bill that $33,000. So let's see, do this. Okay, so we reverse the prior month end, then we build it. So after we bill it, February is going to show 0. So let's say the job was really done at the end of January, we just didn't bill it. Then after February 1st, we bill it. And our February revenue is going to be 0, even though we had a billing in February. And the reason it's 0 is because we reversed that over-under billing from the previous month. So in February, you'll look at a negative and a positive, and it'll equal out. This just kind of goes through the mechanics of the over-under billing process and how it affects your income statement. Okay. So those are the concepts with cost control webinar. Throughout the webinar, I tried to cover concepts multiple times so that so you get them, reinforced and get through it.